The gold chessboard. How a 1.2% tax could shake the U.S. economy at first glance. The new 1.2% gold transaction tax imposed by Switzerland might seem insignificant. Just a small bump amounting to $82 million against the $6.8 billion in U.S. gold imports. But in the high-stakes world of global finance, small shifts can have seismic effects. The Federal Reserve's finely balanced reserve mechanisms are so sensitive that this marginal cost increase could spike bond yields, strengthen the dollar index, and potentially unravel the U.S. strategy to close its $48 billion trade deficit. What's playing out is far more than a simple trade spat. From Utah miners demanding transparency on gold origins, to New Jersey jewelers reeling from rising costs, and Switzerland's refusal to bend on banking secrecy. This is a global gold drama with financial, political, and diplomatic consequences. Today, we'll break down exactly how this seemingly minor tax, combined with a few swing Senate votes, Fed policy levers, and swelling global gold premiums, is building into a major pressure point. Before we dive in, don't forget to like, subscribe, and turn on notifications so you never miss critical updates. The U.S. trade deficit and Switzerland's hidden role in early 2025, the U.S. trade report revealed a $48 billion deficit in goods and services. In response, the White House activated a three-part plan, escalating tariffs on Chinese goods, incentives to shift manufacturing to Mexico, a quiet, tax-exempt import protocol for high-purity Swiss gold. The first two measures dominated headlines. But the third, what insiders call the Swiss file, has quietly become the thorniest issue on Trump's desk. That's because nearly 25% of the trade imbalance traces back to imports from Switzerland, including gold, pharmaceutical ingredients, and micro-mechanical parts. Why Swiss gold matters so much. U.S. gold production is about 180 tons per year. Yet most of it flows into tech and jewelry sectors, not reserves. The Federal Reserve fills the gap through Swiss gold, refined to ultra-high purity in just 4 cantons: Lucerne, Valais, Ticino, and Geneva. These Swiss refineries dominate global bullion flows, making Switzerland irreplaceable, especially under the Fed's reserve protocols. On August 4, 2025, the Bern, Swiss, administration proposed a 1.2% transaction tax on gold refined in Switzerland but sourced from outside G7 countries. The tax applies to each U.S.-bound shipment unless it falls under a mutual reserve swap agreement exempt from third-country reporting requirements. Translation? If the U.S. wants tax exemption, it must accept banking secrecy and loosen transparency demands. If not, it pays more, raising gold premiums and shaking the bond market. The butterfly effect of a small tax and $82 million cost increase may sound minor compared to a $48 billion deficit. But in financial markets, perception creates pressure. The gold premium has already risen by $15 per ounce. This impacts the Fed's reserve strategy, driving bond yields up by 10 to 20 basis points, boosting the dollar index, and making U.S. exports more expensive. The result? The deficit Trump wants to close could actually widen. The core of the conflict is a transparency rule Trump himself introduced in 2024, requiring clear origin tracking for all gold. It pleased the Utah mining lobby but cut off many non-G7 sources and gave Swiss refiners even more leverage. Now, that same rule is biting back, creating supply bottlenecks and pricing pressure in the U.S. jewelry sector. Swiss strategy. Gold tax as a diplomatic lever inside Switzerland. The political calculus is clear. The center-right wants the gold tax revenue to fund protectionist programs, the left prefers climate projects. Both agree. U.S. exemption requests will be rejected unless Swiss banking secrecy is protected. Bern's strategy goes deeper. It's bundling the gold tax with negotiations on pharma imports, micro-mechanical customs quotas, and watch tariffs. Want more mRNA supplies? Accept higher taxes on watches. Want cheaper gold? Drop your demand for full origin transparency. Washington is now negotiating a compromise, a defense logistics certification for Swiss watchmakers, a 2-year FATKA transition extension downgrading Swiss refiners to low risk under U.S. customs rules, but Switzerland won't bend unless FATKA requirements are loosened. More than just gold. The pharmaceutical factor: Switzerland supplies the U.S. with $13.2 billion worth of key pharmaceutical components, especially mRNA particles and advanced chemical catalysts. The U.S. can't easily replace this supply chain. Alternatives like Canada, Ireland, and Belgium offer only half the capacity. So, Bern is tying gold exemptions to drug quotas, forcing the U.S. to balance price pressures in both the jewelry and healthcare sectors. The Fed's dilemma: the Fed is running out of options. Gold's unmatched liquidity and trust factor make it difficult to substitute. While silver, platinum, and oil-indexed reserves are being discussed, none offer the same safe haven reliability. With rising premiums, the Fed may need to inject $75 billion into the repo market to stabilize reserves, directly undermining Trump's plan to shrink the deficit through spending cuts and tariffs. Political tug-of-war in Congress: the Senate Finance Committee is deadlocked. Utah Republicans want strict origin rules to protect local miners. Northeastern Democrats want tax relief to ease jewelry costs. A few undecided votes hold the key. Meanwhile, Trump's "We'll mine our own gold" slogan is falling flat, as supply chain data clearly shows that refining, still done best in Switzerland, is the real bottleneck. Swiss leverage and global market ripples: over 2/3 of global gold passes through Swiss refineries. Even with alternatives like Canada, Australia, or Japan, none match Switzerland's output. The Geneva to Newark route remains the cheapest and most reliable. The rising gold premium, from $7 to $16 per ounce, has already caused fluctuations in the dollar and bond markets. UBS and JP Morgan warn that this could fuel long-term pressure on the dollar, trigger interest rate spikes, and threaten the Fed's balance sheet strategy. 3 paths forward for the U.S. The Fed and White House now face 3 difficult choices. Abandon transparency: right-pointing arrow, lower premiums. Secure gold flow, stick to origin rules, right-pointing arrow, pay more. Risk dollar strength, redesign reserves, right-pointing arrow, use silver, platinum with weaker liquidity. Each option carries separate risks and costs. The final choice will shape policy rates, reserve confidence, and how fast the U.S. can actually shrink its deficit. Conclusion: small tax, giant impact. Switzerland may not be pulling gold from the U.S. entirely, but it's turning a modest 1.2% tax into a powerful economic lever. Trump's efforts to close the trade gap now depend on a few senators, a stubborn gold premium, and fragile diplomatic math. Every tick in the spot price of gold now reflects more than market speculation. It signals the shifting power in U.S.-Swiss relations. The $48 billion trade deficit may seem numeric, but its implications reach deep into the very fabric of the global financial system. Speech balloon: what do you think? Is Trump cornered by a tax that looks tiny on paper but massive in impact? Drop your thoughts in the comments. And don't forget to like, share, and subscribe for more updates.